I guess we're all here. So we'll get started on the second panel. Okay, here we go. So welcome everybody. I'm Louise Shaner, as David mentioned, from the Hutchins Center at Brookings. And in this session, we're going to be talking about state and local responses to the COVID-19 pandemic. Before I introduce our panelists, let me remind viewers that they can submit questions for the panelists by emailing events@brookings.edu or by joining the conversation on Twitter using MuniFinance, #MuniFinance to join Twitter. Okay, so now let me introduce our three panelists. First, we have Lauren Larson, from the Director of the Governor's Office of State Planning and Budgeting for the state of Colorado. We have Fitzroy Lee, who is the Chief Economist for the District of Columbia. And we have Mike Pagano, who is Dean of the University of Illinois at Chicago College of Urban Planning and Public Affairs and the Director of the Government Finance Research Center there, and also a non-resident senior fellow of the Brookings Institution in the Metro program, and someone who's been monitoring city for its fiscal conditions for forever. So with that, we're going to get started. I didn't do a lot in terms of the impressive bios of all the panelists, and you can find them on our event page. But with 45 minutes, I thought we'd just get into it. Okay, so I want to start with first Lauren, and then Fitzroy, and then Michael, about what you're looking at in terms of your revenue forecast post-COVID. And just what kind of numbers are you looking at, and how did you get those, and what was that process? So Lauren.
Good morning. Thank you, Louise, and it's nice to be sharing this time with you all. Greetings from sunny Colorado. I also serve on the National Association of State Budget Officers Executive Committee. And so I can speak for what we're seeing in Colorado, and then some experiences for other states as well. Colorado updated our forecast most recently in June, and we're showing about a 16% revenue decline in our general fund over the fiscal year that just closed and into fiscal 21. We're on a July to June fiscal year. We burned through about 2/3 of our reserves just in the last few months of the fiscal year, which was tough for budget setting for 21. We do now, our General Assembly has set a new budget, and it was very tough because as drastic as that revenue drop is, there's still another 25-30% on top of that to figure out the budget gap, because a budget gap is, we have cost increases, you have a revenue decline, plus you have cost increases. You got to combine the two to get your budget gap. So things are looking pretty grim. We're looking at a square root recovery right now with a bounce back, an immediate bounce back, assuming no big second wave, but a slower return to normal. And that has us forecast, we're down about $1 billion in the third forecast year, which is fiscal 22.
Great, and Fitzroy?
Sure, good afternoon, everyone. Much like Lauren said, we're also looking at lower revenue forecasts. For us, it's about just a little over 700 million in our current fiscal year. Our 2020 fiscal year doesn't end until September, and that's about 9% of our total revenues. And then for next fiscal year, we're still in the process of planning that budget. The mayor sent it to the council, and just last week, the council had a first vote on that budget, and we're looking at $707 million in lower revenues than we had in the previous forecast. The District Home Rule Act requires that we do quarterly revenue forecasts, and we're looking at another forecast right at the beginning of August. Just like Lauren, we're looking at, as you call it, a square root type recovery. So we were forecasting an 8% drop in GDP, state GDP for the second quarter, and then we have it slowly recovering, and we don't recover to our pre-COVID peak until the fourth quarter of calendar year 2021.
And maybe, Mike, you can talk about the city kind of outlook and how they're being affected and what they're planning on.
Thank you, and good afternoon to everyone. I've been, as Louise mentioned, I've been involved with monitoring city fiscal conditions for several decades now in collaboration with the National League of Cities. We are just now getting the data from the survey that we sent out recently, and not unexpectedly, that quite a few of the municipalities are, as you would imagine, and as Lauren mentioned, is happening in Colorado and Fitzroy in Washington, D.C., drawing down reserves, ending balances, rainy day funds, budget stabilization funds, or whatever, is a fairly common strategy. And we've estimated that nearly a third of the municipalities drew down at least 10% of their reserves just for FY20. Again, the fiscal years end anywhere from the first part of April to the end of December. So it's during their fiscal years. And approximately a similar percentage will be drawing down their more than 10% next year. So I think the first response or reaction we get to such a dramatic damage to budgets, unlike what most recessions are, which it sort of rolls in, is that the reserves, which is what they're for, and that they were at their highest historic levels just in FY19, so that they could be used to help cushion the blow a bit. Also, just to note that only a third of the cities are drawing down more than 10% of their ending balances, but that I'm a little caution about that, and that is that a lot of municipalities are losing revenue from the kinds of activities that would be affected when people don't go to restaurants or hotels or to the amusement park. But a lot of cities rely more heavily on their property tax receipts, and the property real estate values, even if they do drop a bit, aren't going to be measured in property tax liabilities until next year or the year after. So I think what we're seeing with those 10 or 30, a third of the municipalities that are drawing down so much now, those are the ones that rely on the sales tax and the income tax as their primary general tax sources.
So, you know, one of the things that I see economists have done a lot of is sort of look at the experience of past recessions to try to understand what the revenue and spending implications might be for this one. You both mentioned some things that are obviously that this is a different kind of recession, particularly in the speed at which activity shut down. But I sort of think of so many other kind of pieces to it. I mean, just starting on the tax revenue, you know, do we think the tax revenue effects are going to be different because of this, like not going to some highly taxed activities like hotels and restaurant? Is that a big deal, or is mostly an income tax that should sort of follow typical relationships between taxes and GDP? Anybody?
I guess I can start with that because one thing you mentioned is the speed with which it happened. So going into the forecast, you know, the usual trajectory for these things is that, you know, you see a weakening in the economic activity and there's a trend and you can forecast from that. This time, the lockdown was immediate and we knew that, you know, the world was different from what it was before. The problem, though, is that we had no data to go on because all the economic data lags by, you know, several months. And so that was kind of the first challenge for us, and which makes it very different from, say, the Great Recession, where we started with a stock market crash and then you could see it leading into a recession. So we had that challenge to begin with. One of the things that we did, we had already started doing that, is to look at more high frequency data. And so we started to gather what high frequency data we had. Of course, for Washington, D.C., we're very, very dependent, at least in our sales tax revenue, on, you know, the hospitality sector. And so we knew that that was, you know, going to devastate our revenue. So we started looking at credit card spending data on a weekly basis. We also look at mobile phone data that tracks the number of people coming into the city. And from that, we were able to get an idea of how much reduction. Also, of course, one critical piece has been the unemployment insurance claims. Looking at we were able to get that on a daily basis. So we were able to track where the layoffs were occurring. And so for us, in terms of revenue, the biggest impact was on the sales tax revenue. About 18% of our total revenue is from sales tax, and about 50% of that comes from the hospitality sector. So that was the biggest piece of revenue. For the individual income tax, of course, we saw with the layoffs that it was going to take a hit on the withholding immediately. The hit is not as big as the job losses. We are forecasting 93,000 job loss between January and July. But because it's usually lower wage jobs, it's not as big a hit on our withholding. And a lot of the higher wage jobs in, federal government, a lot of professional and technical services that supports the federal government, a lot of those people are still working from home. So we've been seeing the withholding doing better than we had forecasted back in April, at least. And we expect, because the stock market, it won't hit until next year. So we haven't been able to assess the final returns yet because of the deferrals. And for real property tax, the first half payments came in because we have first half is due in March and it didn't start hitting until March. But we're waiting to see in September, when the second half payments are due, what the delinquencies might mean in terms of our revenue. But that's where we are now. And we're going to be looking at all the data come August.
Okay. We don't have to answer every question by every person. So if someone wants to jump in on something on that wasn't mentioned, go ahead. Otherwise, I'll ask some other questions. Yeah.
I'll just pop in, Louise, on the NASPO data shows during the Great Recession, the average revenue decline among states was 11.6% over 2 years. And we don't have data in from all 50 states yet, but we're certainly well exceeding that on this trajectory. So faster and deeper.
And I would just add that it took a long time to grow back out of the 2007, the Great Recession, to where, at least for municipalities, the general fund revenues didn't return to their 2007 levels until 2019. So if this is a V-shaped recession, or whatever it's called, will the fiscal benefits come back as quickly as the V or as the GDP, or will it lag quite a bit as it did to the Great Recession?
So that's on the tax side. Then when we think about the spending side, the mayor mentioned that this huge gap coming not just from falling revenues, but also just kind of exploding expenditures. One of the first questions, and that I guess is more of a city thing, is, what are school districts doing? I mean, are they going to be spending more money to try to accommodate it? Can they? Or what are their needs there when we think about that? Mike?
Very briefly, school districts are suffering, besides the great uncertainty about how they're going to open, but they're suffering on the revenue side on probably a lag property tax receipt. And I think Fitzroy pointed out correctly that it's the number of delinquencies that are going to affect whether the property tax receipts this year will be close to last year's. But where school districts in particular are going to be facing a dilemma is when the state's revenues are well under, as Lauren just mentioned, well under what happened after when the Great Recession hit, the 11% or so. Where are the what do states consider to be discretionary? Typically, K through 12, they're not hammered as hard as higher education, but K through 12, again, it's going to be a state question. The other question I think for K through 12 education is, if they do come back, and they come back in a modified form where you're going to have maybe only parts of the student body come back at any one time, and the days extended, and you have more public health officials within that the costs are going to escalate rather dramatically, and how to cover the escalating costs as state revenue is declining and property taxes are at least going to hold their own for this year. I think that's going to be the big dilemma for school districts.
And Lauren, when you, as a state official, thinking about, I guess, grants to local districts, how do you balance that? Do you say, well, we just have to get more money to do this, or what's that conversation like?
Sure. Yeah. Our budget just passed had to reduce our state share to K-12 by 10%. Fortunately, though, and I'm extremely grateful to the Treasury Department for their implementation of the CARES Act. They were able to share some of the CARES Act funds with school districts for those expenses, increased expenses they have. Also, the Treasury Department is permitting second order effects. So we're using, in Colorado, we're using that as support for our workforce. So to the extent districts can increase instructional hours, mitigate lost learning for students, things that support parents to get back to work, they can program their CARES Act dollars for those expenses as well. And we're very grateful for that tool.
I'm sorry. So let's just be clear. So the CARES Act provided $150 billion in aid to states that was supposed to be basically just for corona-related expenditures. And so I think there was some big question about whether or not how expansive the definition of corona-related expenditures would be and whether or not we could think of this as a pot of money. And you're saying that it actually has turned out to be fairly flexible, that could be used for things that you might have not have thought were sort of direct. And that's the U.S. Treasury Department who's allowed that? Is that what you?
Yeah, I mean, flexible's in that certainly not the word everyone's using, but I was the chief of the Treasury branch at OMB, and I have a deep respect for the Treasury Department and the constraints, under the constraints of the statute, they've put forth some guidance that allows states and localities to spend the funds on second order effects, which is very, very useful for some of the meeting these increased costs that districts have, and for supporting the workforce needs that's going to keep our economy going. Colorado's #1 risk before COVID hit was our risk to our workforce, to our skilled workforce in the state, and so that for us, this is a critical piece of our economy.
Fiscal, is that your experience too?
Yeah, and that has been our experience. I was just going to add that we have found that it has had more flexibility than we thought initially. And as part of when the mayor presented the budget, use of that fund was a critical part, shifting around some of the local funds that we found in talking back and forth with OMB, that we could actually use that in some non-direct COVID related spending.
But do I take it from what all of you have said, Mike, too, that so all this advice for school districts to do all this stuff to make it safe to go back to school will be a heavy lift, given still the really constrained financing they face, and that's a need? Does that seem correct?
Yeah, I would only add that I think if we learn lessons from catastrophes, it's that state and local governments are very careful about where they make their rebudgeting adjustments. After 9/11, even for the next couple of years, as we were in the .com bust at that point, cities and many local governments increased public safety spending, even as their revenues were declining. I think the lesson from that is whatever the catalyst was, in this case, a public health crisis, you can expect public health expenditures. In fact, most counties and states have already said they're going to spend more on public health than they did before. Those expenditures are going to increase. So the question is, what's going to get crowded out at the end? Would it be K through 12 spending? And is Warren just mentioned in Colorado, that there was a 10% decline to K through 12. Is that could it have been worse, or could it have been better, depending on what the public health demands are in the state or in any state? Same thing with counties and other local governments. Is it public health spending? Probably public safety spending. Although in the defund police movement, it may reinvent itself as another kind of expenditure activity, but essentially for the purposes of public safety. So those demands that are coming from the taxpayer and the residents are going to come up against some limit. And is it going to be K through 12 support or less, or are there other discretionary parts, what states might and cities might consider to be discretionary parts, that they will start making some adjustments? I think that is at least unknown at this point, and a lot of conversations around that.
And Fitzroy, what has DC done in terms of the school budgets?
So, there weren't major cuts. In fact, there might have been some increases. So one of the things that, when the mayor presented the budget, we were able to do, and, I think you mentioned at the start, at least Mike mentioned that we started with record level of, reserves, and we were able to not cut as much as we had hoped on the areas. I know we're going to get into this later, but it was more pay freezes and so on that we started with. But for some of the key priorities was housing and education. And so they were able to make some modest increase in education in anticipation, as you say, that, going into the next school year, it's going to be very difficult, and they're going to be extra spending that were not anticipated before COVID. So there has not been actual cutbacks in education, at least not yet. When we see the next forecast, that could happen. But for now, given where we are and with the reserve we have had, we were able to make investment in housing and education, and in particular, they're still working on the plan of what K through 12 will look like going into the fall. And I think this week there should be an announcement. So, many school districts are doing that, just trying to figure out what the school look like. But the anticipation is that it will involve extra spending, and there's some provision made for that as they go forward.
And so I guess one implication, you sort of said it now, is if there's a second wave and a W-shaped recession where we go back down again, then this is going to be much harder to adapt to, because kind of some of these one-time things like your rainy day funds and maybe some one-time tricks might be gone. And is that correct?
No, that is correct. And I know we're actually in the my office does the revenue forecast, and every day we're getting call of what it's going to look like in August, because they're trying to make contingency plans about what do we do if it's actually right now, one of the difficulty in making forecasts, of course, is this is not just all economic. It's tied up with what action you're taking to control the virus. And that in turn depends on what happens in terms of the infection rates. And that's one of the things we're grappling with, because we'll probably not know about a second wave until we're in the fall. And so for now, we're looking strictly at the economics of it. And so if there is actually a second wave or the revenue is lowered, because right now we had made our forecast based on what we believe to be, the pace of opening, and we're falling behind that, just because if you look around, people are slowing down the reopening just based on what's happening around the country. And so we anticipate that will have an effect on our revenue forecast going forward.
Laura.
And Louise, if I may, even without a second wave, we're looking at a multi-year budget impact. And if there's anything we've learned from the past two recessions, is they don't hit 1 or 2 budget cycles, they hit 4 or 5, because you're climbing back. You have deferred expenses that you need to make up, and it's just a very slow climb back. I think Michael made this comment in the beginning. So we're, even without a W, we're we've only forecast out through fiscal 22, but planning wise, we need to be looking at least a 4-year revenue decline, and it looks quite severe without additional federal support.
So
one thing I just want to add to that. So one of the requirements as a result of our Home Rule Act is that we're required to do a 4-year budget. And so our forecasts are always 4 years out. And as Lauren says, we're looking at revenue for the entire period of our financial plan. We're looking at lower revenues relative to where we were pre-COVID.
So given that, how do cities and states address their reserve policies and decide how much to use right away and how much to preserve for the W, or they'll just, even without that, the 3 years from now? Mike, do you want to jump in on that?
Sure. Cities and states have been known to revise their reserve policies anytime there's a crisis like this. So that's going to be flexible in the end. It depends on what the state considers to be a safety margin. I know they have targets, but if you fall too far below the target, you want to hold on to that and make adjustments elsewhere. And that's going to be up to state and local governments to decide what that's going to be. But with revenues coming in, if they don't come in quickly, they are going to have to address that problem, but that issue of what to hold in their reserves. But there are other adjustments that they'll make at the same time. And I think that was the point that both Lauren and Fitzroy were making, is that there are rebudgeting adjustments throughout the year. The legislature doesn't just quit, or city council go home after they pass the budget.
Okay. So what about the ability to use debt to help through this crisis? I mean, we always hear about state and local balanced budget requirements. You know, can cities borrow more easily? Can states get around them? How much will debt play a role in trying to get through this crisis? Lauren, you want to start?
Sure. So for Colorado, extending debt is not an easy option. We are restricted by our Constitution from issuing debt without going to a vote of the people. We do have some certificates of participation, which are some asset-backed issuances, and even with those, we're finding that our operating funds are so tight, the service on those are difficult to make, and we've had to shift it out of the general fund and into our highway fund. So it's eating away at what's available just for regular maintenance. So, and you had given us a heads up about this question, and I would give some thought to, why is it? It's a great time to borrow, rates are low. And I think it's when you look, as Fitzroy said, you're looking at a 4 or 5 year window of the budget being so tight that even an increased expense for debt service could feel really a high burden to a state budget, even if you are able to borrow with the will of the people. And in addition, if you're thinking about just generally shrinking as a community, thinking about shrinking the budget, doing more with less, big campaigns about going out and spending a lot, sort of there's a disconnect there. So those are a couple thoughts on what's impacting in Colorado and other states.
For the district, for a long time, they've had really high debt, and several, maybe about a decade ago, the policymakers came together and wanted to control the increase in that debt. So there's a 12% cap and 12% of expenditure that we spend on debt service. And so all of that has been used up more or less in terms of capital and maintenance, the capital budget. And so there's no room in terms of borrowing just to get through the operating side. And in any case, because of our requirement that we have a 4-year budget and financial plan, it's hard to do a lot of one-time deals. If you make a reduction, the financial plan has to be balanced over 4 years. So we'll have to show where you make the cuts. So the practice has been only to use borrowing for capital expenditures.
The short-term borrowing for operating can be done if you're waiting for a tax source. So you can issue short-term notes like that. But long-term debt, I can't imagine is going to increase too much, even though logic might dictate that the interest rate is. But the interest rate, the borrowing rate has been so low for so long that we could have expected a lot more to have been invested in infrastructure over the last decade, except I think, as Lauren points out, you still have the debt retirement issue that you have to work into your budget. And is that going to take away from K through 12 spending or other kinds of programs? And apparently state and local governments aren't willing to act in a counter-cyclical manner the way the federal government can. And instead of borrowing more during the Great Recession or borrowing more right now to rebuild whatever needs to be done on the infrastructure side, the capital budget tends to be a lot more responsive to, in a pro-cyclical manner, responsive to the changes in the economy. And in part, I suspect, is that what state and local governments want to do is maintain service delivery at some particular level. And if they continue to transfer cash from their collections to the capital side rather than to the operating side, that may be a choice they don't want to make. So you end up transferring cash that would have gone to the capital budget back into the operating budget. And you actually see capital spending declining in some cases, not because there's not as much capital from the bond market, but rather because there's not as much capital from cash transfers from the state.
I was muted. So actually we had a question on an email that you sort of mentioned. So this delay of the federal tax deadline, seems like one of those short-term cash flow issues, although perhaps there's some worry that people actually won't be able to make their final payments, sort of like the property tax delinquencies. So is that something that most cities or states, well, mostly states, I suppose, for income tax, just borrowed for that cash flow delay, or is that something that they actually cut spending to try to meet in the fiscal year?
I guess I can start with that because that was something, as we were going into the forecast, that we worried about a lot, as our CFO said. In this period, cash is king because we have to. One of the things, I mean, and you probably all know, because we're still a creature of the Congress, and one of the things is imposed that we couldn't. If one of the, we have had way back in the late 90s, you probably know, we had a control board, and when the control board left, it was only dormant. And one of the requirements that if we can't pay our bills, if we run out of cash, then that would be one reason for a return of a control board. So we have guarded the cash. We were lucky coming out of 2000 that we had a lot of cash reserve. But one of the things that we had to do, and our treasurer did a lot of financial analysis just to see where we would be on cash. And so one of the things we were looking at was whether, given the low interest rates now, whether we should just borrow, as Mike mentioned, more tax anticipation notes. And we actually took out that line of credit. We were able to do that just in case. We believe that given all the cash reserve, we'll be able to make it through. But one consideration was, of course, the deferral of income tax payments. And locally, we did some for the hotels because they were in so much trouble. We deferred their real property tax payments in March as well. So, one of the things we're nervous about not having able to see the final payments for so long is what happens when we start to look at those figures. But for sure, in terms of the cash flow, we were really worried about what the deferral would do to that. But given where we were at the end of the year and looking at the analysis, we think we will make it through.
Lauren?
Yes, we squeaking by on the cash side. We did implement a sequestration in April, given where it looked how fast we were burning through our reserves. So that was a significant action that we took rapidly to try and rein in some spending before the end of the fiscal year.
Wait, sorry, so just like across the board cuts in spending, or what?
Not across the board. We were strategic. We had our department sort of at the ready to be working on where there might be saving or spending they could forego, and so we asked them very quickly, give them a target and a financial target, and they were able to meet it, and we issued an executive order to sequester the funds. But we are looking very anxiously at the July data because we increased our allowance for delinquencies and bankruptcies, and seeing what actually comes in the door with the extended tax deadline. We're all waiting with bated breath.
And what about considering not sort of reducing pension contributions? Is that a non-starter for most places? Is that something that's on the table? And that's a city and yeah. So Mike, go ahead. I see you nodding.
I guess I can say I hope not. I think this is one of those. As the mayor of Oakland, your previous panel just said, is that her first decision is always what's in the long-term best interest of Oakland, as the mayor. And I think cities and states have to do the same thing. What's in the long best interest of the city and the state? And that might be the easiest but it can become habitual after a while. And I'm in one of those states where we are suffering from having that can kick down the road so far that to not make pension contributions now would be probably the worst thing to do.
And politically, how would that just be viewed as a
politically I think politically in this state it may be a way through in the short term, but I don't think they're seriously considering it. I think that has played itself out so well over so many decades now that I don't think that card's going to be played now as a political card.
I just wanted to add that in the district, I mentioned coming out of that financial crisis, there was a restructuring, and the federal government took over a lot of the pensions, and so the district has been, and then all the benefits that they have taken on, we have been able, the OPEB funding, that has been fully funded for a number of years now. In fact, overfunded over 100%. So luckily for the district, that has not been a problem. And one of the things that we've done is to keep funding one of the priorities in the mayor's budget was to keep funding those at the level we are, the OPEB, the ones that are still on our books for firefighters and teachers and so on. So right now it's fully funded, and that's one thing they've tried not to touch, again, for political reasons, as you mentioned. So, we have not dipped into any pension funds right now.
So there's a question that I probably should have asked, but we get from one of our viewers, which is one thing we have not mentioned, although I think Mike might have mentioned, Fitzroy, you mentioned a little bit. So when we think about budget balance requirements, we the UI claims don't count against those. So are UI claims something that states are just happy to borrow for and don't worry about, or does the fact that the claims are so high and that means there's pressure down the road actually affect the other decisions about what to spend? Lauren?
Yeah, I'd say it's somewhere in between. Because we are able to access borrowing at a low rate for those expenses, it is helping. And Colorado didn't have the reserves we needed in our UI claim fund. I haven't looked at that as a national analysis. I'd be interested to know. But I think we were far short of what we needed, and that will be significant. But I'll tell you, we're so grateful right now for every dollar spent on UI, both what the state's spending and what the federal government has sent. The extra $600 a week is making a huge difference in consumer spending, and it's keeping the economy going. And this is another thing, late July, August, we're going to be looking at the data very carefully to see what's happening with consumer. If that extra payment turns off and is not extended, we'll be watching what happens to consumer confidence, and then we'll very quickly be looking at this consumer spending data to see how quickly that impacts behavior.
That's interesting. So I was going to go to my last question, which is what aid do you need from the federal government? And I was sort of thinking about aid to state and local governments. As you mentioned, that's not the only thing that matters. So I'll let each of you quickly respond. We have 5 minutes. So what are you looking for from the federal government? What do you think they should be doing? Why don't you start, Fitzroy?
So I would start, let's say, we would welcome additional federal aid, and this time around to be welcome being treated as a state rather than like a territory, because the last time we got less than most other states because they were categorizing us as a territory rather than a state. And so we actually got less. And even though it has been very helpful in helping to balance the budget, we would welcome, very much welcome more federal aid, and this time treating the district more like a state.
Nick?
Yeah, as I think most state and local governments have already found out, is that it's going to be a rolling hit, as those that are highly reliant on the sales and income taxes are already getting a hit. They'll maybe pick up a little bit sooner if the economy picks up. But if we're going through, as you mentioned, Louise, a W, then they're going to lose it again. There's only one other source that can borrow for operating purposes, and that's the federal government, and that can provide the kind of support that allows for states and metro areas in particular to understand that they are very, very diverse and heterogeneous. They're not all exactly the same. Some communities relying on a property tax, middle upper income, and they're able to work from home, are certainly not getting hit as hard as other communities that are unlike that. So the federal aid needs to distinguish among the needs of those state and local governments, number one. Number two, this has nothing to do with your question to Louise, but a plug that this is the time for state and local governments to seriously rethink their fiscal architecture, what they have created, their fiscal levers on the economy that they're drawing resources from. It's a critical time to rethink this rather than doing some changes around the edge of what already exists. Thank you.
Never let a good crisis go to waste. I like that. Indeed, we're looking to do some restructuring in Colorado and try to reduce our spend so we'll have more available for investment. But there's just the basic math here where for the next at least 3 years, we're going to be in a really difficult situation without additional federal aid. So NGA and NASBO have called on Congress to provide an additional $500 billion in state aid, and some other additional pieces around the FMAP, the Medicaid match, and some education spending as well. And then, as I mentioned before, it's in terms not directly to the state, but to beneficiaries, we're seeing that the UI enhanced benefit is having a tremendous effect on our economy. And we really hope that Congress will consider extending that.
Great. Well, with that, I think our time is up. I really would like to thank all of you for what I think was an interesting and informative session. Good luck. I know you have very tough jobs, at least 2 of you in government, figuring out how to handle all this. So thank you for taking your time out of that and coming to talk to us. So that's the end of this session. We are heading right into another panel, which is the COVID-19 Municipal Bond Market Response and Outlook, which will be moderated by Rich Reifel. So stay tuned through a brief transition, and Rich will bring it up from there. And thank you all again.
Thanks for watching. Be sure to like and subscribe for more videos from Brookings.